In April 2026, Meta reported its first quarter earnings. Despite record performance, the stock immediately dropped as investors reacted to the fine print. The core business grew revenue to $56.3 billion, a 33% jump year over year, while maintaining a 41% operating margin. This chart shows the $145 billion capital expenditure guidance clashing with that revenue growth. This single spending target is what drove the market's sharp reversal. Meta is allocating these billions to massive GPU clusters, custom silicon design, and next-generation AI data centers. This presents a specific trade-off. It is either a generational entry point for a high-margin compounder or a capital-intensive project that will weigh on Meta's free cash flow for years. Meta's 2026 spending target is nearly double what the company spent on infrastructure in 2025, marking a sharp departure from its historical capital requirements. The company is effectively transitioning into a heavy infrastructure developer, requiring the massive physical footprint seen in these industrial-scale data centers. To manage the hardware costs, Meta is deploying its own custom MTIA inference chips alongside third-party GPUs to handle billions of AI-driven interactions. This ground-up rebuilding of Meta's computing infrastructure carries immense upfront costs, creating a high-stakes capital commitment that has significantly altered the company's near-term risk profile. The success of this infrastructure pivot depends entirely on the ability of the core advertising business to fund it. In the first quarter of 2026, Meta's ad impressions increased by 19%, while the average price per ad rose by 12%. This pricing power comes from shifting to internal AI-driven targeting. Better algorithms drive accurate ad matching, commanding higher prices. Engines like Lattice and Advantage Plus improve return on ad spend, directly supporting these higher price points. Reels engagement has also stabilized, helping Meta maintain its share of user attention against competition from TikTok and YouTube. The advertising engine is currently generating the necessary cash to support Meta's transition into an AI-first infrastructure company. Analyzing the $145 billion budget requires breaking that figure down into specific categories of risk and return. Meta's AI investments map across two axes: return probability and time to revenue. Defensive AI is monetizing today, a high-probability, short-term return. Monetizable AI shows promise but lacks discrete revenue. Long-term optionality, like Llama models, is highly speculative, presenting the greatest margin risk. Because CapEx is concentrated in the second half of 2026, the depreciation on these servers will hit the P&L heavily in 2027, leading to a significant contraction in free cash flow. Investors must wait through this period of depressed yields in exchange for Meta owning the underlying infrastructure of its next growth cycle. There are two other significant segments outside the main social feed that contribute to Meta's total valuation. Reality Labs remains the primary drag on consolidated profitability, with losses continuing to mount as the company builds out its vision for augmented reality. This segment is operating at a roughly $19 billion annual loss, with no clear timeline for reaching a break-even point. However, the Ray-Ban Meta smart glasses have become a surprise success in AI hardware, with daily users tripling year over year, according to management. This scorecard highlights the contrast. While Reality Labs loses $19 billion, WhatsApp helped drive a 73.5% increase in other revenue. Monetization comes through paid business messaging and AI-driven interactions, providing new revenue streams from a global user base. These segments are a package deal. Reality Labs' losses are the price of entry for the growth potential in smart glasses and enterprise messaging. Meta's current stock price and forward valuation multiple reflect the weight of these operational trade-offs. Meta is currently trading at roughly 17.3 times forward earnings, placing it in the high-growth, low-multiple quadrant relative to its Magnificent Seven peers. This is a steep discount to Microsoft, Alphabet, and Amazon, as the market prices in the heavy CapEx and the ongoing losses in Reality Labs. The valuation also accounts for a shifting legal landscape. In late 2025, a federal judge ruled the FTC failed to prove Meta held an unlawful monopoly, significantly reducing the probability of a company-wide breakup. With much of the infrastructure spend and legal risk already reflected in the current 17 times multiple, the stock offers a distinct margin of safety for investors focused on long-term growth. We can map this financial profile to specific investor goals to determine if Meta fits your portfolio. Value investors focused on immediate free cash flow may find the 2027 depreciation wave too restrictive for their risk parameters. Growth investors, however, may see Meta as a highly profitable company that is successfully self-funding its own infrastructure build-out at a discounted multiple. The primary metric to track over the next 12 months is the guidance for 2027 capital expenditures. If 2027 spending stabilizes while AI-driven ad efficiencies continue to improve, the resulting cash flow could lead to a significant valuation re-rating. Meta in mid-2026 is a test of patience, a massive bet on the company's ability to convert upfront infrastructure spending into a durable competitive moat.